Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, along with Brianna Valesky. We have Sean Emory on the line, portfolio manager at GFG Capital and author of themarketmeter.com. Sean, how you doing this morning?
I'm doing great. How you guys doing?
Good. Thanks for coming on. Just tell us a little bit about your book, themarketmeter.com, and some of the basic tenets of it.
Okay, yeah. So the Market Meter is a site that I run. The whole theory behind it is giving your retail investor, your everyday investor, kind of institutional advice. That's really the mantra there, and providing some, I guess, daily ideas, measuring the market, the risk, the reward, and in an easy fashion, just providing that to your everyday reader.
Okay, let's hop right into the retail sector, and we've had some punk earnings at best. Macy's getting beat up a few days ago. Kohl's just getting daylights kicked out of it. Now, JW Nordstrom, a little bit higher end, recovered. Let's talk about the retail sector as a whole, and perhaps maybe touch on Michael Kors.
Okay, yeah. So, yeah, the last couple of days it's been whacked, especially like Kohl's and Macy's. But over the last year, the sector's done really well, outperforming the broader market. Part of that is lower oil prices. The transition from brick and mortar to e-commerce has really fueled that rally. And yeah, one stock which hasn't is Michael Kors. I think every woman in America owns something of Michael Kors. The stock's down 40% since February 2014. And when I look at Michael Kors, I see a great brand, a great balance sheet. They're adding new product segments, and the company's targeting roughly 700 stores globally over the next several years. Broadly speaking, too, 400 domestically, 200 in Europe, 100 in Japan. But really the best part of, I guess, Michael Kors to me is the balance sheet. If you look at the balance sheet, it's roughly 60% gross margins, and that's expanding due to the scale that they've achieved. They have nearly $1 billion in operating cash flow, nearly $1 billion in cash on the balance sheet, trading at 13 times, and they have no debt. So while all this is great, when I look at the technicals, they're pretty awful. So no reason to jump in, I guess, today, but I sit here and wait for this name to really form a base, show some signs of life, and then really look to get involved. I'd say in the next couple of months, the Kors is one of those names in that retail sector that you're talking about that is really on my radar.
So do you you take a few months to build a position? So I mean, we are finding some support here. I mean, at this level. So just we don't talk to portfolio managers much about how they actually build it. Well, that's not really forming support. We took out a new low here, made a low for the move at 60.24. But I'm looking on the monthly chart, and I do see it coming down to 60.08. So are you just going to let it fall another buck here, maybe start nibbling at the $60 area? Or is there some key technical indicator that you use, maybe a big washout down day on huge volume? How do you go about building a position in Kors?
Yeah, so again, we want to see a big base form. Right now, you're seeing a down channel for Kors pretty much since kind of September, pretty well defined. And when we're building this position, it's pretty much, we don't build it in stages. We allow the stock, the price, to kind of consolidate around a range. Your price point is very much in line with our thought process, that 60 level. We want to see things like the moving averages start to flat out, start to correct back upwards. We want to start seeing the momentum indicators, so RSI, MACD, some of those start to become more bullish divergences versus price. That will give us that indication that there's potentially a trend change. So while we like the company, we like the business and the story, we want to see the price start to react more positively and build that position with a stop loss right below kind of what our target support level is. So in this case, let's say it was 60. We would target maybe 59.50, 59 as a stop loss and see if we can actually catch this bottom and ride this thing to kind of our intrinsic value.
And what's your intrinsic value for it?
Today, it's roughly 79.
Whoa, whoa. Okay, all right. So you're more of like take the stab approach. We'll try and buy it here. If it doesn't work out, take the small loss. Try it again. Go in with the full position. Take the small loss. Is that more of your approach?
Yeah, I mean, the purpose is to find a company that we can own for a long period of time. It doesn't have to be a long period of time if the move is quicker than anticipated. But again, we're looking for something where we can generate a 10% return on our investment year over year. And if we can get that bottom, then we ride it until it hits our intrinsic value. But again, at the start, we're minimizing our losses right at the beginning. We don't want to have a 15, 20% correction in our name and be stuck in the stock because, again, sometimes, or the mantra is, in the short term, it's a voting machine. In the long term, it's a waiting machine.
Okay.
And that's kind of how we view our investments.
Okay. Moving on here. The importance of a concentrated portfolio. The S&P 500 has been boring for 6 months now. Investing in a concentrated portfolio makes sense. Only 21% of the S&P 500 companies are up 10% or more compared to 2.6% of the market. So you look at the internals are weak. Percent of stocks above the 250-day continues to diverge from the S&P price here. What's that indicate to you?
Yeah, so again, there's not that many names that look that strong within there, and that's can be shown by some of those internal indicators you're referring to. So the percent of stocks making new highs, the percent of stocks above their 50 and 200-day moving averages. As that continues to fall, you're seeing less and less participation of the entire market. So that further emphasizes kind of the rationale behind a concentrated strategy. This year, so the market's up, 3 and change percent. There's over 100 companies up 10% or more. So we want to be in those names. We don't necessarily want to be broadly across the board. Another thing to look at is if you're a fundamental investor and you pay attention to valuations. One interesting note is if you look at the top 50 stocks on a market cap basis and look at the valuation of those today, it's roughly 16 times earnings. And you compare that to a period like 2000 when those top 50 stocks were trading at roughly 26 times. There's a handful of names, especially these mature big ones, that are trading at reasonable valuations. So there's less and less names to choose from a technical side, from a valuation side, and we want to be concentrated today. One of our other mantras, and it's Friday, so it's day of I guess giving all our mantras away. But put your eggs in one basket and follow that basket carefully. Warren Buffett is that quote, and that's something we follow closely in our single equity portfolio.
So it seems like you're a little cautious up here at all-time highs. You're not barreling in and really going for this breakout to new all-time highs.
No, I'm not buying the market. Again, we've been looking at the S&P. We've been looking at small caps. Well, small caps have stayed above their new highs, but the internals, again, don't suggest that we're moving into this, I guess, breakout with strong conviction. I looked at volume over the past couple of days. Volume hasn't been that high. I think yesterday it was 86% of the average daily volume over the last 3 months. The day before was 82%. I don't know the number on the top of my head, but we haven't had huge volume days on some of these moves. And from a valuation standpoint, it doesn't make that much sense to be broad. And again, we're just selecting single names that both technically and fundamentally look strong. And that's how we're going to generate our alpha, our returns, and instead of being broadly into a market like the U.S.
Earnings season broadly here. There's a couple ways to look at it, relative to expectations. It seemed like, some of these companies that, blew away the numbers that had the run up into it were kind of tagged like Apple or Disney. And then it seems like some of them that had like the lowered expectations, but they come in above those lower expectations, they rallied. How would you characterize this overall earnings season?
Yeah, so there's a couple ways to look at it, and you were referring to it a little bit. Looking at the beats and misses, which are against analyst estimates, and or the absolute earnings data. So I tend to focus on absolute earnings data, and I guess pardon my honesty, but I usually care less about if John Doe's estimates from XYZ's firm are beat or missed. So when we look at markets, earnings and markets move in unison over long periods. Therefore, absolute earnings are always in focus. So earnings season is telling us a couple different things, and we're focusing on a couple different things. First is oil prices and its effect on energy. Second is the U.S. dollar on foreign kind of revenues. So broad S&P earnings are flat, literally right at zero. Sales growth is -4. But if we start to strip out things, so if we remove energy from the equation, earnings are 7%. Sales are roughly 1%, far away from, I guess, a panic. To sort out kind of that currency story I was talking about, and a lot of people are talking about, I looked at small caps. They're more domestic in nature, and also the currency adjusted revenue for the S&P 500. So currency adjusted revenue for the S&P 500 is 5.7%. So that's not bad. Small caps are seeing roughly 9-10% earnings growth, 6-7% sales growth. So that's also not bad. So the earnings season kind of headline numbers are not encouraging, but when you start to do a little digging, things are not that bad on the earnings front.
Okay, so but there's other places to put your money too, right? You don't have to have all your money invested in the United States. Looking over the pond here, do you got any plays overseas?
Yeah, so Italy, and we talked about it last time, Italy remains our top European choice. I mean, everything is better in Italy. There's great food. There's nice cars. The technicals and valuations are even more attractive. So if we are comparing to places like Germany, I guess last time we spoke, we talked about the mean reversion trade of Italy trying to outperform Germany. That gap has closed by roughly 6%, mostly due to Italy's outperformance. Germany's been pretty flat. Italy's up roughly 6%. But owning EWI still makes a ton of sense above that 14.75, 15 level we spoke about. If you look at Italy, it's one of the cheaper markets globally. On a book value basis, Italy usually trades at roughly a 25% discount to Germany. Today, that discount is 40%. And technically, it's pretty strong. Some of those indicators I was referring to before, the MACD, the RSI, the moving averages, a clear support and resistance, all that is well-defined, and we think it makes a good case for an investment.
Yeah, nice run up here in Italy since the beginning of the year. Got the weekly chart here. Seem to be running into a little resistance at 16. Uh, any
Mm-hmm.
place you in over the pond that you would kind of stay away from?
So Asia's been something we've liked, but obviously the move's been pretty quick. So that's always worrisome if you're looking to get in and kind of where's your stop loss. If you're looking at a ticker like PEC, which is China A shares, that's an area where you want to have your stop losses in place. You want to have them tight. Otherwise, you're going to get burned if you're trying to kind of ride the momentum. PEC is that ETF. Just
What's the
looking at it,
symbol
it
on
takes
that?
up
What's the symbol?
PEK.
Okay, thank you.
So yeah, it's trading at roughly
Oof.
61, 64. So is kind of the highs. You have around that 57 level, which is the previous low. If we take out that 57, you don't want to own this. You're probably going to be in trouble. We might go back to those 45, 46 levels. I just keep buying the highs on this and selling new lows. But that's the only market really that I'd be fearful of, just because the momentum is so strong. And when there's momentum that's that strong, typically the reversal is just as strong or stronger.
Okay, words of caution there on China. Finally, we're gonna wrap up this segment here in a few minutes, and we're gonna talk about commodities here. We don't talk about commodities a lot on the show. We talk about crude oil. So let's start with crude, and then let's see what other commodities you're eyeing and the reason for your entry into the commodities markets.
Yeah. So at first we were buying the oil servicers, right? We were buying some of the oil service stocks, the Halliburtons of the world. And that was predominantly based on the fact that, one, we're buying a great business. And then two, we were seeing some bullish divergences in oil. That took place. Oil has really rallied pretty quickly. We've seen the past couple of days it's taken a breather. This is similar to the China story. I mean, these momentum stories, they take breathers. So you have to be prepared for that. But there's a couple things which really make commodities attractive today. If you look at rate hikes over the last 40 years, commodities is one of the best performers just before and 18 months after. Keep in mind, economies are usually expanding. Inflation is generally rising. Some could argue that's the opposite today. But also a $1 trillion or $10 trillion Chinese economy, the ECB looking to stimulate. Those two things further provide runway for commodities. And then the technical picture, if you're looking broadly at like a ticker GSG, we're hitting on we broke below the 2009 lows, and we're pushing right back on them again. I wouldn't own it below that 2090 level. The upside is actually rather large, just like the oil chart. The ticker GSG is 69% energy related, so it's really a play on oil, right? But then you have some exposure to some of the softs and other parts of the metals. So when we look at the commodity story, it's really those different factors, from the technicals to the seasonality during rate hikes, and then also some of the factors of the China and ECB story. So it's those different factors that are giving us some comfort in owning something like commodities to take advantage of this huge correction that it has.
What about gold?
Gold. So gold is part of GSG. We don't look at gold that specifically, but I know it's breaking or broke above. If you're looking at like something like GLD, it broke above that 115 mark. We had kind of like a little symmetrical triangle, double bottom from the November lows to the March, April lows. We got that breakout, so it's something that we're not focusing on greatly. We took out the 20-day moving average. We took out the 50-day moving average. Those are some bullish signs for the momentum in this name. But again, just something that looks pretty bullish, not something that we're paying too much attention to. But if you just look at the chart, it doesn't look bad.
Well, I mean, a lot of this is tied to interest rates, right? With commodities, what do you think? You think interest rates are going to be getting bumped up here, September, December, 2016, or never?
So we've been in the camp of it's very difficult for the Fed to hike rates. The reason they will hike rates is because they are nervous about the situation of the credit markets as opposed to the cycle of the economy. The fact is, if you look at some of the economic indicators, especially now, the economy is growing, but at very slow pace. Not enough to warrant a rate hike. A rate hike, at the end of the day, if they do take it to 100 basis points or 75 basis points or 25 basis points over the next year or so, that's still pretty much at all-time lows in terms of the Fed funds rate. So when we look at that, a Fed rate hike doesn't really mean too much to us. We think they're going to do it because they're going to be spooked that credit is too easy. And it just seems that they're very much worried about the credit markets. High yield issuance, especially covenant light issuance, has been pretty heavy. So that is a concern we think is in their minds, which will kind of promote them to rise or do a rate hike here by the end of the year. But we don't think it's really as tied to the economy as they're framing it to be.
We've been on the line with Sean Emory, portfolio manager at GFG Capital and author of themarketmeter.com. Broad outlook at the markets, Europe, commodities. Really appreciate it, Sean. We'll talk to you again soon.
For sure. Have a good one, guys.